You expect gravity to work, right? You drop an apple, it falls. But in financial markets, sometimes you drop that apple and well, it just hovers in midair.
Yeah, it completely defies the supposed, physics of raw fundamentals.
Exactly. So welcome to today's deep dive. We're looking at a stack of institutional research notes, some behavioral finance journals, and historical sentiment charts. Our mission for you today is decoding this mystery. Why do buyers suddenly just vanish even when a chart is rising and the economic data looks absolutely perfect?
Right, it's totally baffling when you just look at the math.
Okay, let's unpack this.
Yeah.
So we're really talking about market sentiment here. That bizarre gap between the actual facts on the ground and how traders, well, how they feel about those facts. Is sentiment essentially like a pressure gauge for assets?
Yeah, I think that's exactly the right way to think about it. It drives movement through expectations and fear, urgency, rather than just raw data.
Hmm.
And what's crucial is that in the short term, prices often decouple entirely from an asset's intrinsic value. Like, an equity can look objectively undervalued based on earnings.
But it still drops.
Exactly. If that pressure gauge of sentiment is heavily negative, the math won't save you from a severe sell-off.
So if intrinsic value doesn't dictate that immediate price action, what is actually, building up the pressure inside that gauge?
Well, it's the interaction between the data and the crowd's interpretation of it. What's fascinating here is a phenomenal economic release can actually trigger a total bloodbath.
Wait, really? A bloodbath from good news?
Yeah, think back to those 2023 and early 2024 jobs reports. We saw massive job additions, but the S&P 500 would just drop heavily in minutes.
Oh, right, because of the rates.
Right, algorithms and traders panicked. They interpreted that objectively good news as, a guarantee of tighter monetary policy.
I mean, but if it's just FOMO and panic driving this reaction, aren't we just describing like an irrational herd? Why treat it like actionable data at all?
It looks like pure herd mentality, sure, but it's actually a very specific blend of human interpretation and mechanical financial positioning.
Okay, how so?
Think about how positioning works. If sentiment is incredibly high and everyone is aggressively positioned for the market to go up, meaning, they've already deployed all their cash into long positions.
Oh, there's literally no one left to buy.
Exactly. No one is left. So no matter how good the subsequent news is, the market just has no fuel left to rise.
So that positioning is why good news suddenly results in a sell-off. The sentiment tension finally overpowers the underlying asset.
Precisely. The buyers are exhausted.
Wow. So if sentiment can build this invisible momentum, and we know positioning can exhaust a trend, we can't just guess when it's going to snap. We need actual footprints.
Yeah.
What metrics are institutional traders using to actually see this invisible pressure?
You look at the interaction between participation volume and news flow, and you pair that with tools like the VIX or extreme put-call ratios. Yeah. But honestly, the biggest tell is divergent behavior. You watch what happens when a market gets undeniably good news. If bullish headlines hit and volume spikes, but the price fails to break resistance.
Or it reverses entirely.
Yeah, or worse, it reverses. That is a glaring footprint that the underlying positioning is completely exhausted.
Oh, wait, if we see that footprint, if the crowd is completely maxed out on one side and clearly ignoring reality, shouldn't you just immediately play the contrarian? Like, if everyone is out of cash, just aggressively bet against them?
No, that is the ultimate contrarian trap.
Really? Why?
Because extreme sentiment can remain wildly stretched far longer than your margin account can stay solvent.
All right.
Fading a crowd too early is just as dangerous as chasing them too late. You can't just step in front of a freight train simply because you read a high put-call ratio or, notice some moving average divergences.
So, because extreme sentiment can stay irrational for so long, it can never really be a standalone strategy. It has to be like a contextual layer.
Yeah.
It's the market's emotional temperature, but it's not the whole weather report.
Exactly. If we connect this to the bigger picture, you need to use sentiment to understand the underlying market pressure and respect the crowd, but never follow it blindly.
You have to line up those sentiment footprints with actual technical setups.
Yeah, and strict risk management discipline.
Well, here's where it gets really interesting, though, to leave you with the final thought. If market sentiment right now is driven by distinctly human flaws, FOMO, fear, collective panic, what happens to this emotional temperature in the future?
That's a great question.
Right. As AI and automated algorithms take over the vast majority of trading volume, will those machines develop a sentiment of their own? Or will our hovering apple finally just obey the laws of physics and hit the floor? Something for you to think about until next time.